capital asset pricing model, not used to determine the risk premium. Okay. Obtaining the premium from a specialist data provider, not use, I mean, you can do that using the current interest rate on corporate bonds, using implied returns based on future expectations, using historical average of returns over a period of time. So yes, you can do the last one. Implied returns based on future expectations. You could do that too. Current interest rates of current corporate bonds. I don't. Why would you do that for equity? Yeah, bonds is debt. Calculate the WACC. Okay, so let's take this data. Some people call it data. Some people call it data. I'm gonna call it data because I want a data. All right, here we go. All right, let's do the WACC. So you've got the cost of debt pre-tax. We want the after-tax cost of debt. What's wrong with me? We want the after-tax cost of debt, right? Okay. Then we've already got the cost of equity. Okay. Then you've got debt, and you always want to use the market value. You never want to use the book value. So what we want to do is we want to sum the market. Oh, yikes. We want to sum the market value of equity and the market value of debt, right? And then we want to get the, because this would basically be the target capital structure. And what this does is it gives us the proportion of debt and equity in the capital structure. So now you've got, this is after tax cost of debt. You already got the cost of equity, and then you got the proportions of equity and debt. So this is equity, right? And this is debt. So now we simply take the cost of debt, multiply it by the debt in the capital structure, plus the cost of equity and the proportion of equity in the capital structure. And that's the WACC, 5%. I'm only a C student, y'all. Beta. All right, let's unlevered beta. Well, we already know what the formula for unlevered beta is, so we just got to work it out, okay? So we've got the levered beta, start there. Then we want to delever it. So it's a division problem. Okay, 1 plus 1 minus the marginal tax rate times the existing debt to equity ratio. So that is the debt in the existing capital structure divided by the equity in the existing capital structure. 3.17. And we know that's correct because it's coming down. And it's 177, so rounding up to 3.18. And then we're going to calculate the WACC for the below company to 1 decimal place. For the company to 1 decimal place. Okay. Now let's calculate the weighted average cost of capital to 1 decimal place. Okay, so the after-tax cost of debt is 1 minus the marginal tax rate. And so that's the after-tax cost of debt. And then we got the cost of equity is right here. It's not an issue. We got the equity. All right, so this is the trick. They're trying to trick you by giving you the book